Think your business is profitable? Think again. Your business could be bleeding cash and your profits are telling you nothing about it. Here's the brutal truth. Your profit and loss, balance sheet, and cash flow are completely different stories. And the gap between them, that's where profitable businesses go broke. In the next few minutes, I'll show you exactly how to read all three, and not like an accountant, but like an owner who needs to survive. I'll show you what you need to watch out for most, what numbers are important, and how these statements connect together. I'll even show you the one connection most business owners never see. Let's get started. Before we dive into each statement, I want you to see the big picture first. You've got three financial statements. Think of them as three different lenses on the same business. The profit and loss, or P&L, tells you how much money you made over a period of time. It's based on revenue minus expenses equals profit. Simple. The balance sheet tells you what you own, what you owe, and what's left over. It's a snapshot of your financial position at a single point in time. The cash flow statement tells you where the cash actually went, because profit and cash are not the same thing. And this is the one that most business owners never look at, but it's arguably the most important too. Now here's how they connect. Your net profit from the P&L flows into your balance sheet as retained earnings. That's the profit you've kept in the business. But whether that profit actually turns into cash depends on things like how long it takes you to get paid, whether you bought equipment, or whether you took money out as a director. All of that shows up in the cash flow statement. So when a business owner tells me I'm profitable, but I have no cash, I know exactly where to look. And by the end of this video, you will too. Now let's start with the P&L because it's the one most business owners are familiar with. The structure is simple. You've got revenue at the top. That's your sales, your income, money coming in from your customers. Then you subtract your cost of goods sold, or COGS. This is the direct costs of delivering your product or service. If you're a tradie, it's materials. If you're an agency, it might be contractor costs. What's left is your gross profit. And this is a really important number because it tells you how much you're actually making on the work before you pay everything else. Then you subtract your operating expenses, rent, wages, software, insurance, all the overhead costs of running the business. What's left is your operating profit. And then after interest and tax, you get to net profit, the bottom line. Now here's where business owners get tripped up. One of the most common mistakes I see is misclassifying costs, putting things in COGS that should be in operating expenses, or vice versa. And when that happens, your gross profit margin is wrong, which means you're making decisions based on bad data. Here's a simple rule. If the cost goes up when you do more work, it's probably COGS. If you pay it regardless of how busy you are, it's probably overheads. Get that right and your P&L actually becomes useful. The other thing I want you to understand is the P&L is based on accrual accounting. That means revenue shows up when you invoice, not when you get paid. Expenses show up when they're incurred, not when you pay them. So you can have a great looking P&L and still have a cash flow problem. Which brings us to the balance sheet. The balance sheet answers one question. What's the financial position of the business right now? It's built on a simple equation. Assets equals liabilities plus equity. Assets are what you own. Cash in the bank, money owed to you by customers, inventory, equipment, and vehicles. Liabilities are what you owe. Supplier invoices, tax obligations, loans, and credit cards. Equity is what's left over. It's the owner's stake in the business. It includes the money you put in, plus the profits you've retained over time. Now, as a business owner, you don't need to analyze every single line, but there are 5 accounts I want you to check every single month. The first one is cash. What's actually in the bank? Do you have enough to cover the next 90 days of operating expenses? If not, that's a red flag. Number 2, accounts receivable. This is money your customers owe you. And more importantly, how long is it taking them to pay? If your accounts receivable are growing faster than your revenue, you've got a collection problem. Number 3, accounts payable. This is money you owe suppliers. Are you paying on time? Are you using your payment terms strategically? Number 4, loans and liabilities. What debt do you have? When are the repayments due? Are there any balloon payments coming up that could surprise you? Number 5, director's loan. This is a big one. If you're taking money out of the business personally, it shows up here. I've seen business owners with a profitable P&L and no cash. And when I look at the balance sheet, there's a $500,000 director loan. The business made money, but the director has just taken it all out. The balance sheet tells you the truth where the money actually went. Now we get to the cash flow statement. This is the one that ties everything together. It answers the question, why did my cash balance change? The cash flow statement breaks it down into 3 sections. Number 1, operating activities. This is cash generated from running the business. It starts with your net profit and then adjusts for things that aren't cash. Depreciation gets added back because it's a non-cash expense. Changes in receivables and payables get factored in. If your receivables went up, that's cash you earned but haven't collected yet. So it reduces the operating cash flow. Number 2, investing activities. This is cash spent on assets. Bought a new vehicle, new equipment, that shows up here. And here's the thing, when you buy a $50,000 ute, it doesn't hit your P&L straight away. It sits on the balance sheet and gets depreciated over time. But the cash, that's gone immediately. This is why you can be profitable and still short on cash. Number 3, financing activities. This is cash from loans, paying down debt, or distributions to owners. If you took out a loan, cash comes in. If you're making repayments, cash goes out. And only the interest portion shows up on your P&L. The principal repayment, that's invisible on the profit and loss. It only shows up here. So when a client tells me they're busy but broke, I look at these 3 things. How long is it taking them to get paid? That's the receivables issue. Did they buy equipment or take on debt? That's the investing and financing piece. And finally, did they take out money personally? That's the director's loan. 9 times out of 10, the answer is in one of those 3 pieces. So here's what I want you to take away from this. You don't need to become an accountant, but you do need a monthly rhythm where you actually look at your numbers. Here's the 5-question check I recommend. 1, what's my gross profit margin? And is it consistent? Number 2, what's my operating profit and is it trending in the right direction? Number 3, how many days is it taking me to get paid? Number 4, do I have at least 3 months of operating expenses in cash? Number 5, is my cash flow from operations positive? If you can answer those 5 questions every month, you'll catch problems early. You'll make better decisions and you won't be one of those business owners who's profitable on paper but can't pay their bills. Now, the next thing you need to understand is what to do when these numbers don't look right. So go watch this video next where I break down exactly how to fix a cash flow problem before it becomes a crisis. And if you want further help to look at your numbers and see if they're working for you, click the link in the description for a strategy call with our team. We'll see you in the next one.